Every few years, the same question returns. Is a crash coming? And every time markets start behaving strangely, people look back to one moment, a year that changed everything. Banks collapsed, markets crashed, millions lost their wealth, and the world realized something important. Financial systems are not as stable as they seem. Now, years later, the same question is being asked again. Are we heading towards something similar? Is 2026 the next 2008? To answer that, you don't need prediction. You need comparison. Because crashes don't repeat exactly, but patterns do. And those patterns are what matter. Before 2008, everything looked strong. Housing prices were rising, credit was easily available, banks were confident, people were making money, and that confidence created risk, hidden risk, because when money becomes easy, discipline disappears. Banks started giving loans to almost anyone. People borrowed beyond their capacity. Institutions created complex financial products, all based on one belief: prices will keep rising. But they didn't. And when reality hit, so the system collapsed. Now fast forward to today, the environment looks different, but some behaviors feel familiar. The first similarity is easy money. For years, interest rates were low, liquidity was high, money was available, and when money is available, people take more risk. Investments increase, speculation increases, and asset prices rise. But when interest rates increase, everything changes. Suddenly, borrowing becomes expensive, liquidity reduces, and pressure builds. The second similarity is overconfidence. Markets have gone through long periods of growth. People have made money, new investors have entered, and many believe the system is stable. But confidence is dangerous because it removes caution, and when caution disappears, risk increases. The third similarity is leverage. Today, leverage exists in different forms, not just loans, but derivatives, margin trading, speculative positions. And when markets move against leverage positions, the reaction is fast, because positions are forced to close, and forced selling accelerates decline. The fourth similarity is disconnect from reality. In every cycle, there comes a point where price and value separate. Assets become expensive, not because of fundamentals, but because of momentum. People buy because others are buying, not because they understand what they are buying. This creates fragility, because when momentum stops, there is nothing supporting the price. The fifth similarity is belief in control. Before every crisis, there is a belief that systems are stable, that institutions can manage risk, that governments can prevent collapse. But history shows something different. Control is limited. And when pressure becomes too high, systems break. But here is where things are different. Because this is not 2008. The structure of the system has changed. Banks are more regulated. Risk management is stronger. Information is faster. Markets react quicker. And central banks are more experienced. This does not remove risk, but it changes how risk behaves. Crashes today may not look the same. They may not be as slow. They may not build the same way. They may happen faster or in different areas, different sectors, different assets. This is important because many people are waiting for something identical, but markets evolve and risk evolves with them. So the real question is not, will 2026 be exactly like 2008? The real question is, are the conditions for instability building? And the answer is partially. Some signs exist. Some patterns are visible, but not everything is aligned, which means one thing: uncertainty. And uncertainty is where most mistakes happen, because when people expect a crash, they act too early. And when people ignore risk, they act too late. understanding environment, understanding behavior, understanding risk, because crashes don't destroy everyone. They mainly affect those who are unprepared, those who overexpose, those who ignore warning signs, those who believe this time is different. The disciplined trader does something else. They reduce risk when uncertainty increases. They stay patient. They wait for clarity. They do not force trades. They do not chase movement because they understand something simple. Opportunities exist in every market, but survival is more important than profit. So is 2026 the next 2008? Maybe. Maybe not, but the exact year is not the point. The point is this: markets move in cycles, confidence builds, risk increases, pressure accumulates, and eventually something breaks. The only question is, are you prepared when it happens? Because the market will not warn you loudly. It will show signs, quietly, gradually, until suddenly everything changes, and those who understand the cycle don't panic, they adapt, they survive, and they take advantage of the opportunity. This is capital era.